Welcome to this lecture number 19. Now, in the last lecture, we have discussed about certain aspects of the conservative principle of accounting, and also we have discussed certain methodology where the business entity may resort to by showing some kind of distorted numbers. Now, in this session, we will take you through an example of a change in accounting process, how it impacts the profit and loss or balance sheet, income or expenses of a particular entity. Now, what has happened is that, so in this session, we shall give you an example of a live real life examples of change in accounting standard, how it can impact the profit and loss. A change of revenue recognition norm. The terminology of revenue recognition norms means when the revenue would be recognized, because time to time, as the complexities of the economy changes, complexity of the business changes, the regulatory body like the FASB, Financial Accounting Standard Board. Now, what is happening is that now in that case, they come up with some kind of new norms. So when these new norms come, so they can impact the revenue or the profit and loss of a business entity. Now, analyst, the moment these new norms is announced that okay, it will be implemented from this date, analyst carry out this analysis beforehand to see how it is going to impact the profit and loss or the balance sheet of an entity. Now, ASC 606 is the new revenue recognition standards that affects all business that enter into contract. So it has happened around about 2 years back into contracts with customers to transfer goods or service, public, private, and non-profit entity. So ASC 606, you can search in the Google and you can find out it's a revenue recognition norms changed by the FASB. Now what has happened? Once these norms changes, now every entity, if it's a listed entity, they will state how this application will impact or is impacting the income, expenses or balance sheet or asset part. Now, Amazon has mentioned the impact of this rule as follows. These timing changes will include Amazon branded electronic devices sold through retailers, which would be recognized upon sales to the retailer rather than to end users. So what has happened? Prior to these norms, what is happening? Anything which is Amazon was selling to the retailer cannot be booked as an income. So when this retailer is selling to the end consumers, that they are booking as an income. But because of this change in rule, what is happening? They would be able to recognize the sales. Let us look at it. At Amazon, at t is equal to 0, sales to retailer, and t is equal to 1, retailer sells to end customer. Under the previous system, it would be booked in this case. So that means at t is equal to 1, that is profit and loss. The first entry would be the debit balance sheet asset receivable. Suppose it is doing it in the form of a deferred or accrual basis, so it is receivable. Second entry would be credit, P&L, income, sales. So in this case, when it is booking, even the shipment is happening here, but the actual revenue booking was at t is equal to 1. Now, under the present system, under the new system change in standard, it will be booking it here. Why it will be booking it here? Because this rule says that it will be recognized immediately upon sales. So what will happen? Amazon's revenue will increase because why? The revenue which was booking in the subsequent years would be booking now. Now this increase will impact 1 or 2, 3 quarters. After that, it will be actually normalized because it will impact 1 or 2 or 3 quarters depending on seasonality or etc. But after that, the new rule on that base, the growth will take place. So this actually impacts the revenue recognition norms. So revenue increase in t is equal to 0. Now, and what is happening? Amazon has also mentioned that the unredeemed portion of our gift cards, which will begin to recognize over the expected, the customer redemption period, which is substantially within 9 months, rather than waiting until gift cards expire or when the likelihood of redemption becomes remote, generally 2 years from the date of issuance. So what is happening? The gift card, which is actually not redeemed. Now, when they should book it as an income. So in that case, what they are saying is, as per new rule, they would be recognizing it over the expected customer redemption period, which is substantial within 9 months, rather than previously they used to wait it for 2 years. So T is equal to 9 months and T is equal to 24 months. Now, under the previous system, what you used to have is that if they have got this amount, so the income, other income, it is basically the equity and liability, it is coming in the form of a commitment. Now, under the new system, what will happen? Here itself, it would be coming as an other income and it would be coming as an commitment. So if you look at it in this case, the unredeemed portion will be coming it here. So what is happening in the previous period? It is the other income is coming. Now credit P&L income side, in the other income it will come, and balance sheet, it is a commitment, it will come. So in this case, it will come as in this part. Now revenue increase in T is equal to 9 months. In addition, certain advertisement servicing will be classified as a revenue rather than a reduction in cost of sales, when it was actually getting some amount from the dealers or etc. Previously, what it used to have, it was shown as a negative of advertisement, negative of expenses. Now, in this particular, because of this rule, what used to have, it would be able to show it as an income, as an advertisement services. So you see the change in the rule is how it is impacting Amazon. How it is impacting Amazon is that it is actually preponing the income, and preponing the income at the time of point of sale to the to dealers. And where another part is happening is that now and give the unredeemed card also, they can show it as an income. And in that case, what will happen in that case? Whereas in the card of some of the advertisement expenses, they are earning actually. The advertisement services, they are earning. So they can show it as an income rather than as a negative of expenses. So all this is reflecting in the increase in revenue. So this gives an example is that how changing the accounting norm can impact the revenue of a business entity. Now, if you can search in the Google, you can get the enough number of examples. But what I am trying to point it out, please try to see the impact on the framework of these kind of accounts. That means in this form, if you can see the framework, any kind of complexities you can understand. So it's a very important point that always keep it in your mind that P&L, income, expenses, balance sheet, asset, liability, and how it can changing, that you can easily find out. Even complex to complex transaction, you can break it by applying this logic. Now, thank you so much. So revenue increase, thank you so much for listening to this video.